Did you know that the total personal loan market in India is expected to reach a whopping 3.5 trillion rupees by 2024? In the recent years, we've seen a significant growth in the loan market in India. This growth is not just confined to the cities, but is also spreading rapidly across the rural regions. Technology and digitization have played a major role in this expansion, making loans more accessible to the masses and simplifying the process like never before. Now, let's talk about what a loan actually is. In simple terms, a loan is an amount of money borrowed that is expected to be paid back with interest. The lender could be a bank, a financial institution, or even an individual. In India, there's a diverse range of loans available to cater to different needs. Personal loans, which can be used for any personal expenses, are quite popular. Home loans cater to those looking to buy a house, while education loans help students pursue higher studies, both within the country and abroad. Car loans, business loans, and agricultural loans are some other types of loans available in the market. Banks and financial institutions are the main providers of these loans. They assess the borrower's creditworthiness, decide on the loan amount, interest rate, and the repayment period. The borrower then repays the loan in installments over a specified period of time. Loans are crucial in our lives for various reasons. They provide financial assistance in times of need, be it for medical emergencies, education, or buying a home. They also help in boosting the economy by enabling businesses to expand and create more jobs. However, loans come with their own set of responsibilities. It's important to understand the terms and conditions, interest rates, and repayment schedules before you take one out. Remember, loans are not just about borrowing money. They're about making informed decisions and managing your finances wisely to achieve your dreams. So, whether you're buying a home, starting a business, or going to college, there's a loan out there that can help you reach your goal. Banks and financial institutions may use a lot of jargon, but don't worry, we're here to break it down for you. Let's start with the term interest rate. Imagine lending a friend 20 rupees and they return 21 rupees to you. That extra rupee is the interest. In banking, the interest rate is like that extra rupee. It's the cost of borrowing money, usually expressed as a percentage of the amount borrowed. Next up, principal. It's not your school headmaster, but the original amount of money you borrowed before interest. If you took a loan of 1,000 rupees, that 1,000 rupees is your principal. Now, let's talk about EMI. It stands for equated monthly installment. Imagine splitting your loan repayment into smaller, manageable parts, like dividing a pizza into slices. Each slice, or EMI, is a part of the total loan you pay back every month. Then there's tenure. No, it's not about professors securing their jobs at universities. In banking, tenure refers to the total time you've agreed to repay your loan. It could be 6 months, 5 years, or any other period. Last but not least, collateral. Picture a pawn shop. You give them your precious watch, they give you money. If you don't pay back, they keep the watch. That's collateral in a nutshell. In banking, collateral is an asset you pledge to secure a loan. If you fail to repay the loan, the bank has the right to take the collateral. So, there you have it. Interest rate is the cost of borrowing, principal is the original loan amount, EMI is your monthly repayment, tenure is the loan period, and collateral is the security against your loan. Remember, understanding these terms can help you make better decisions when it comes to taking out a loan. Investing can be a great way to grow your money over time. But where do you start? Investing, in its simplest form, is all about putting your money to work for you. Instead of letting your funds sit idle in a bank account, investing allows you to put that money into avenues that have the potential to earn strong returns. There are various types of investments that you can explore. First off, we have stocks. When you buy a company's stock, you're essentially buying a piece of that company. As the company grows and profits, so does your investment. Next, we have bonds. Bonds are like loans, but in this case, you're the lender. Companies or governments issue bonds to raise money, and they promise to pay you back with interest over a certain period. Then there are mutual funds. A mutual fund collects money from many investors and uses that pool of funds to invest in a diversified portfolio of stocks, bonds, or other assets. It's a great way to diversify your investments without needing a lot of money. But remember, with every investment comes risk. The potential for high returns often comes with the possibility of high losses. That's the concept of risk and return. The more risk you're willing to take, the higher your potential returns could be. But always be sure to invest within your comfort level and financial ability. Investing might seem intimidating at first, but with a little knowledge, you can start making your money work for you. Scene script. Insurance is a vital part of financial planning, but what exactly is it? Well, in simple terms, insurance is a contract represented by a policy in which you, the policyholder, receives financial protection or reimbursement against losses from an insurance company. You pay a fee, known as a premium, and in return, the insurance company agrees to pay for specific financial losses that might occur during the term of the policy. Now, why is insurance important? Imagine you're driving your new car and out of nowhere an accident happens. Or think about a sudden health issue that requires immediate medical attention. The cost of these unexpected events can be sky high, and that's where insurance steps in. It's a safety net that helps you manage risks and protect against potential financial disaster. There are different types of insurance available, including life insurance, health insurance, and car insurance, to name a few. Life insurance helps provide for your loved ones after you're gone, health insurance covers medical expenses, and car insurance covers vehicle damage or injuries to other drivers if you cause an accident. Let's break down some insurance terms. A premium is what you pay for your insurance policy. The beneficiary is the person who will receive the money if an insured event occurs. And a claim is a formal request to an insurance company asking for payment based on the terms of the insurance policy. So, whether it's protecting your health, your car, or your life, insurance can give you peace of mind.